Today on the interview with me, Aisha Faridi, I've got Vikas Pershad, Portfolio Manager at M&G Investments. He tracks one of the most exciting Asia equity market stories. Let's find out what he's finding interesting next or exciting next. Vikas, welcome to ET Now. Thank you so much for your time. Vikas, from your global lens, what are the big macro trends that you foresee which are impacting equity markets across the world?
So what we're dealing with more and more these days, and we've been having these conversations for a long time. It's always wonderful to come back. But this era is different from previous eras, certainly from when we started talking 15 years ago, in that technology and public policy keep coming up as the main drivers of equity markets. Fixed income also, but my focus is equity markets. Sometimes it's a little bit more policy, sometimes it's more tech. But if you look at North Asia, just over the past month, semiconductors, memory, semiconductor production equipment. If you look at policy when it comes to pharma names here, or you look at the defense sector in Europe and in India and in Japan this year. Public policy, demographics, technology all coming together to drive opportunities in the short term, intermediate term. Also, what I would say in the long term, one of our foundational beliefs is that markets will continue moving higher because they have to. So if you look at the Value Up program in South Korea, the corporate governance transformation underway in Japan, the fact that Xi Jinping is now allowing entrepreneurs to make money in the markets to go higher and higher in China, it's because we don't have very many mechanisms for people to preserve and then grow their wealth. The stock market is the best way. I know in the short term there are concerns about AI bubbles or valuation multiples in the short term, but our view is that for many reasons, including demographics, markets will keep going higher because they have to.
Why do you say they have to? I mean, there have been periods of extended and long bear markets as well, cases in points like Japan, or for that matter, China, took very, very long to come back from the COVID lows. So why do you believe that we're in a structural upswing in equity markets and that this is going to continue?
It will continue. It might not be any one, not all markets will move uniformly.
Sure.
So we've seen that this year. Look at the wides of India versus emerging markets, India versus developed markets. By the way, that's improving the setup into 2026. We can talk about that later. It's a little bit too early to talk about 26, but India's setup heading into next year is looking pretty good. And so we've seen dispersion this year, but overall, tech will drive it, policy will drive it, defense sector, infra spending, education, healthcare. All these sectors are going to drive equity markets higher because that's where the growth is. And this is a great home, a great time for active stock picking as well, whether it's at a country-wise allocation level. Coming into this year, we were underweight India. In our India strategies, we've been fully deployed. But relative to the bottom-up opportunities we saw in Japan, in South Korea, in Europe, in China, and Hong Kong, we thought that it served us better to have more capital allocated there. So not every market will move together, but the trend is clear to us. It's going to be higher. I could have stayed home in the U.S. and invested in that market. I could have picked a different asset class. I've chosen to do public equities in Asia with a focus on India because I think that's where the money is.
So let's talk about first back home, or the earlier home, the US. And there too, you're seeing a concentration of the Fab 7. That's where the earnings growth is, and that's where all the equity money is finding its way. I mean, you know, we often joke about as to how the quarterly profits are larger than GDPs of a few countries. Do you think that concentration or that fear of the tech bubble, like you rightly highlighted, is unfounded? Or do you sense that not for too long will the Fab 7 remain as Fab?
So it's a fair question, something that we think about. I do think that the Fab 7, Mag 7, whatever you call it, that cohort will change over time. Number one, if you look at the number of trillion-dollar companies in the world, aside from Aramco in Saudi Arabia, there aren't any that are outside the U.S. There will be a trillion-dollar market cap company in India someday. I don't think it's listed yet. I don't see it among the current companies, but stay focused on the U.S. for a moment. We have shifted from the top-line earnings growth story being the solo driver of the Big 7 or the Mag 7, Fab 7 in the U.S. to now they're spending a lot of money. What we are looking for are the beneficiaries of that spend. So I think when you look beyond the biggest 7, if you just focus on the top 4 hyperscalers, for example, they've gone from spending $5 to $10 billion a year each to approaching $100 billion each. Now, they need a return on that. Higher returns are probably available for where that money is going. So whether it's semiconductor chips, whether it's memory, and we've benefited from that this year. Power, cooling. There's so much focus on AI and advanced computing these days. Our focus is on how are you going to power this? New chip architectures, cooling architectures. And so when you look at that, there will be some very large companies that come out of that, and that's where we're looking.
But do you sense that the investment theme, at least in the U.S. equity markets, will revolve around AI and tech?
Yes.
And there's no other way?
Yes. I see that it's not going to be services companies. I don't think it's going to be retail. I don't think it's going to be defense or healthcare. There's pressure on those sectors in the U.S. It will be led by tech. And more hardware than software. We see that continuing. I think software is in a difficult position. If you look at, it's not just the Indian IT services companies or the US IT services companies. More broadly, software is under pressure. You and I could have started learning coding in high school or college. Many of those skills would be obsolete today.
Yeah. C++.
Yeah, same. Well, I'm even older, so different languages. But yes, you don't need that today. You don't. Everybody's doing vibe coding these days, and people. That's where the money is. But hardware is very important, and I think still, despite the hype that we've seen, not enough attention is being paid there. The current chip architectures that we have, the current power infrastructure that we have, will not let us get to where we need to be in 5, 10, 15, 20 years. And for that,
why do you say that?
Well, as we were talking offline just before we started, if you look at the first iPhone that came out, 4 GB at the low end, the current one, some of us have the newer one, 2 terabytes of storage.
You do.
I do.
And the orange.
I have the orange one.
Yeah.
I have the orange one. It's a little bit bright for my taste, but why not? A little bit different. But from 4 GB to 2 terabytes in one device, it's 500x in 18 years. Then you look at the DRAM that is powering that, the high-speed memory, that has gone up by multiples. If you look at high bandwidth memory, the AI servers, the needs are growing exponentially, but the capacities are growing linearly, which is why then you've seen pricing go up so much. You've seen the memory companies in the US and in South Korea, the earnings expectations over the past 2 years for several of these companies have gone up by 5 to 7x, all largely driven by pricing, because the capacity is not meeting it. The demand is so high. That's just memory. If you're going to have new chip architectures, you need more equipment. And as you have more equipment and you have more devices consuming power and computing data, then you need more energy, more efficient energy systems, so power semiconductors. Many of those companies are in Japan, Germany, and the US. And then cooling also. New cooling technologies will be needed. So when you have demand growing exponentially, capacity growing linearly, then in the short term you're going to have these huge spikes in pricing. But in the long term, you need new technologies to keep up, and that's what we're looking at.
So who do you think can lead the hardware piece when it comes to AI and tech? And will it continue to be the US?
No, I don't think so. I just came back from 3 weeks in the US over the summer, and what was surprising to me was the lack of appreciation at a broad-based level, at all strata of academia and in the corporate world, of the advances China is making. It will be the US and China. I don't think it is either or any longer. But China is leading the world in EVs, in energy storage, in robotics, in AI. There are companies that are still exceptional in the US. But what I see is the concentration of the focus in China is on these new chip architectures. The fact that they are now telling their companies, you don't need to buy from NVIDIA, we're going to figure this out at home. If you look at total wafer fab expenditures, so this is the etching equipment that makes the semiconductor chips. These machines routinely sell for $10, $50, $100 million. China's share of that market, which is about $100 billion a year, over the past decade has gone from about 5% to 40%. Now that's starting to come off again because they've learned these technologies, and the homegrown companies that started off as small businesses are becoming giants. So China's developing its own standards, and we are headed towards a world in which there will probably be 2 standards, China's, and people aligned to China, and then the US and people aligned to the US. Just like the currency system might change, dollar, yuan, that I think over the next few years will change as well. We've seen dollar weakness this year, It's probably not done. In that context, it's interesting that even though the dollar has been weakening against most currencies, the currency here has been weakening as well. I hear it whenever people travel abroad.
Yes. It's quite a pinch.
It's getting pinched.
Yeah.
Yes. So I don't know about the pace of the rupee against the dollar or against other currencies, but dollar weakness, as our base case, it's hard to make predictions, but probably continues.
So you're saying that what you're seeing in China is just a very nascent phase of not just what they're doing economically, what they're doing within the country, but also what the equity markets so far are reflecting. Mm-hmm. Is that right?
Yes. So, and credit to you. We've been talking about China for years.
Yeah.
You were there early in highlighting this opportunity. We have followed since then. We've allocated a lot more capital to China over the last 2.5 years. Mm-hmm. That has served us well. And that continues. We continue to be overweight Chinese equities in our broader Pan-Asia portfolios. There's a lot to like about that market. Headline valuation multiples are still low. Now that's usually the last thing we look at, but they are still low. What we look at in judging the appeal of a security or a market, it's all bottom up. We're looking for earnings growth, large white spaces, credible management teams, clean balance sheets. We find that again and again and again in China.
And also the structural shift. I mean, what you're talking about China is also them getting back to the drawing board and completely rethinking their strategy.
Well, cars are a perfect example. The auto industry has been around for well over a century. And when you look at the systems in place for auto manufacturing in Europe and in Japan and in the US, they are on that old standard. The Chinese really wanted to dominate the world in ICE vehicles.
Yeah.
Didn't happen. Then what they realized, what we're sensing or seeing, we can see it in the facts, that they wanted to dominate in EVs, and they are.
BYD, yeah.
Exactly. And so they approach it very differently from traditional auto manufacturing. They see it just like a cell phone, that this is a piece of tech-enabled hardware. We're going to iterate very quickly. We're going to drive costs down as low as we can, which they do in every sector. And we're going to ensure widespread adoption. It is a problem already for non-U.S. markets because of the import restrictions. It's not a problem yet for the local manufacturers here. I think politically it's very sensitive, of course. Yeah. But if the Chinese auto companies enter a market, they will take the lead pretty quickly, based on what we see.
Sure. Where else can you see China dominance? Because while China makes better perhaps, makes cheaper perhaps, they also make it for their own country. I mean, can we see an Apple or a Meta emerge out of China and, have global dominance in that sense?
If you look at the consumer products from Huawei and from Xiaomi, they're world leaders in what they're doing. Now, in some of this, there's still a little bit of the copycat stigma that people associate with Chinese products. But if you look at cars and gadgets, foldable laptops from Huawei, these are revolutionary products. They are different. It's not like some of the Western manufacturers where there seems to be not much change from year to year in the smartphone, aside from maybe the color. But in China, these are different form factors. The costs are much lower. The capabilities are much higher. So in consumer electronics, clearly, they're becoming more and more global. In consumer brands also, I'm not a big Labubu fan, but
nor am I actually.
I don't really get it, but I've seen fads, and this seems to be a little bit more than a fad. But that's another example of something that started in China, started in Asia, and has gone global. Gone global. Some of the retail chains, the companies like Mixue ice cream, Miniso retailing. These you would not have seen in the West a decade ago, and you are now. They're global. I was in Georgia 2 months ago, and there's a Miniso shop in one of the malls.
Or Squid Games.
Or Squid Games.
Yeah.
So K-pop, the Korean wave K-pop, also. Yeah. So it's nice that rather than everybody on this side of the world consuming sports or Friends or Western media, now people are waking up to what's happening here. You log into one of your favorite streaming platforms and you see Hindu mythology everywhere now. Indian stories taking over. People in South America watching Sacred Games, as an example. So India's time will come also. There's infinite stories here to tell. Harder to see a consumer electronics brand here going global yet, based on what I see, but something will take off. something will get caught up.
You know, there is one end of companies doing good, countries getting more sort of inclusive and more domestic in terms of manufacturing and selling and everything else. And then on the other hand, there is also the entire, tariff tirade which has taken over the world. Is that going to come at the cost of a slowdown in the US? And then what happens to the Mag 7 or the Fab 7?
Well, we are seeing it. Consumer spending power in the US is not great. There's a huge concentration of wealth. When you leave the big cities, or even in many parts of big cities, you see this. Many people are struggling, and the wealth accumulation in the US post-COVID has not been widespread. And so that's a problem. On top of that, the tariff policies from the US since January have caused a lot of issues for the agricultural sector, for manufacturing. Meanwhile, they're creating other opportunities out here. There was a series of headlines around the visas a few weeks ago. But if anything, that will drive, in the longer term, people back here, will lead to opportunities here. I just returned from Pune yesterday, and I was very impressed by the quality of the manufacturing that I saw. And not only were there Indian companies there, but Indian subsidiaries of foreign companies, but foreign brands also, some Chinese, some European, some American, all building in India. Some of those manufacturing jobs will come here as well. India is well placed to benefit. I know in the short term, there's been pressure on the market. There's been pressure on short-term revenues and earnings. But in the long term, it's very helpful. And that's not just lower-end manufacturing. There's a lot of automation that I saw in the plant tours I did in Pune. Semiconductors. We're not going to have a TSMC equivalent in India anytime soon. But we're going to start somewhere. And the fact that Lam Research or Micron or Disco from Japan or Renesas from Japan are focused here is very encouraging.
Is that the reason that's keeping the FII fraternity away from India? The fact that, A, there are other markets like China, for instance, which are doing a lot better and better bottom-up stories, and also the earnings slowdown along with valuations?
Yes, I think it's a combination of that. This year in particular, it's more that China, Japan, and South Korea are very exciting. Coming into 2025, the South Korean market was a very poor performer. We had the coup headlines in South Korea. The tech sector had sold off. So the setup coming into this year was perfect for South Korea, and we've benefited from that. Hong Kong, China, there's been some false starts over the past few years, but the DeepSeek moment at the start of the year, that was this year, not that long ago, woke a lot of people up to that. And the continued headlines and the progress of the Chinese tech sector is waking people up to that. And Japanese equities broadly have been cheap for a long time. And now you have the whole semiconductor AI story as well. So it's not that the India story has been derailed. If anything, I've gotten conviction that it's very much intact in my last few trips. But other things are better. Our capital is finite. We can't invest in every market. And coming into this year, other markets looked better. The question on valuations is an interesting one. Our contention has always been that India is pricey, not expensive. So what does that mean? It means if something is expensive, you're not getting something in return. But the multiples here are high because it's the highest growth market in the world. For a quarter century, it's been that way. It's the highest ROE companies in the world, the highest earnings CAGR companies in the world. And in the long term, that should remain intact. So for us, we view a market where the long-term earnings compounding has been at 11, 12% a year. That probably should continue. We're seeing more buybacks in the IT services sector, for example, more focus on dividend yields. So when you start adding that up, you get to a potential 13 to 15% rate of return.
And so much liquidity going into IPOs.
Yes. I saw some more numbers that the next 12 months might be $20 billion plus. So the pace of IPOs continues to be high. The size of the IPOs is getting bigger. It's been the busiest IPO market in the world the last 4 years by volume. That should continue. We get the question often, why is this happening? It's quite clear. There's thousands of companies out there. And the the markets give you a mechanism for compounding your wealth. When I moved to Asia in 2005, there were less than 10 billionaires in India, at least on paper. Now there are more than 200. And it's not just in Bombay, not just in Delhi, but all over the country. Yeah. Which leads to other opportunities for investors, but businesses also, wealth management, luxury travel, services, goods, experiences, all that. And that's reflected in our portfolio. 20 years ago, our portfolio was very heavily weighted towards consumer staples, towards private banks, and towards IT services. Those are all underweight for us now because we see other opportunities elsewhere.
So where are those other opportunities when it comes to India? And before that, actually, let me finish what we were talking about. What's that headline number that will make FIIs as a pool come back to India?
It's hard to see. I thought that they would start coming back this year, given the underperformance that we had seen already, starting in September last year. So Q4. So after a blistering run for the equity market, in 6 quarters, the Indian market was up more than 60% in dollars and in rupees. Q4 was weak. We started off weak in the small and mid-cap space. So I thought by the summer people would start coming back to India, and then the whole AI trade has taken off in the late summer. I don't think there's one number for FIIs. Most FIIs remain underweight India. Some see it as too esoteric. Some see it as too specialty, that you need to be on the ground, you need to have followed it for a long time. I don't buy that. But then also they get spooked by the valuation multiples or the historic volatility of this market. But what you have now is a market where the political leadership has been very stable. Up until this year, the currency has been relatively stable. Steady devaluation, but pretty stable. The highest growth companies in the world. So I think it's very appealing. For us, this is a great setup on a multi-year view. Meanwhile, the domestic bid continues to be strong. And I don't see that slowing down materially from here.
So what are your sector overweights right now when it comes to India? Because you're one of the few FIIs who's continued to remain invested in India.
Yes. And so if you look at our top 10 holdings, it's 10 different sectors. That's not by design. It just happened that way. We're bottom-up investors. So we have hospitals. That's done well for us. We have travel, so OTAs. That's done well for us. We continue like that. Consumer tech platforms. We also have real estate. That this year has been a bit of a laggard, but we're still constructive on that space. We do have some financial exposure, but mostly this year has been more about NBFCs than the private banks for us. That might change. Defense also, despite the run that the defense companies have had over the last 3 years in particular, we still have a lot of capital in that sector, and that opportunity is going to be around for a long time. So those are the main holdings that we have. And then conversely, on the other side, staples, private banks, or banks in general, and IT services, they are the lowest weighting we've ever had. And I don't feel like we need to change that. Nothing we learned yesterday, as earnings season kicked off, has changed that view. However, what's exciting is you're seeing one large pool of capex being announced, and a direct beneficiary here in India. And investors are waking up to the fact that there are opportunities here for that. Everything is not just in the US, Japan, China, and South Korea. So we'll see if that continues. It should, because there's a lot of infrastructure that needs to be built out here.
I often wonder that when you look at the global trends, and like you also rightly highlighted, it's either tech, AI, or their derivatives.
Right.
Can you make that same parallel or draw out the same parallel when it comes to India? Or do you have to really have that consumer tech angle when you evaluate markets and opportunities in India?
There are many fewer companies here.
Yeah.
So the good thing about India, the amazing thing is how broad and deep the markets are. We now have more than 6,000 listed companies here. Yeah. Nearly 2,000 with a market cap over $100 million. Now, there's nothing special about that $100 million, but it's still a big number. That's where the liquidity starts to pick up. And despite that, there's very few direct AI beneficiaries that are listed. The ones that are listed, there's some supercomputing EMS companies that are here. We've seen the rally in Tata Communications today, and in some of the companies like ABB, Siemens, L&T, that are seen to be beneficiaries of AI-related capex. But those are parts of a larger company. Yeah. Whereas if you look at auto parts, broad and deep universe, defense, the broadest and deepest universe probably anywhere in the world of defense companies here, and pharma, hospitals, diagnostics. We can go on and on. Real estate, private banks, public banks, NBFCs. So it's a wonderfully broad and deep market, but for this. And this is why then you see India at all-time wides against emerging markets, against developed markets. But it's not going to last for the reasons we were talking about earlier, that the long-term story remains intact. This should continue to be a high-growth market. If you look at it, the equity market today, capitalization, let's say rough number is $5 trillion, GDP of $4 trillion. In our careers, if India continues to grow at 6 to 7%, then in 20 years, the market will have doubled twice. So the 4 trillion becomes, let's say, 16. And if you look at the US, it's a bit of an outlier, but a 2 multiple market cap to GDP, or more than that, actually. So if that happens here, then you're looking at a market cap for the equity market of 30 trillion plus from 5 today, just in the next couple of decades. So there's going to be a lot of growth. It may not all be tech, but there's so much else to look at, which is very exciting for us. And there are ways to if you do your homework, if you bet right, you sit tight, you can outperform the market. And that's why I'm here. Otherwise, I'd be sitting somewhere else.
Yeah, in South Korea?
Maybe in South Korea.
Japan.
Japan.
Yeah.
Japan.
Okay, Vikas, thank you so much for your time today.
My pleasure.
So much insight. Thank you.
Thank you.